initiatives that are on the ballot out here in California, which the California clients would be well advised to be aware of. And then we'll get into updates on tax filing because, we're really at the approaching the end or starting the last part of 2024. And you know what that
Man,
means? That means tax filing responsibilities for this current year, which, believe it or not, is 2/3 over.
it is. It is. It is. Boy, 2 days out of the week that I really hate:
Yes.
Tax Day and Halloween.
Yeah,
Man, oh man, oh man.
yeah.
So no, but anyway, got it. You mentioned something about now in your talk today. You're going to touch on cryptocurrency.
Yes. Well,
Okay.
not cryptocurrency specifically, but specifically the digital currency initiative that's really been pushed quite heavily by the federal government.
Yeah, yeah.
And
Okay.
it's actually called the Fed Now.
Okay.
And actually, technology has outstripped most people's imagination, and the
Mm,
technology is there, but the problem is that there's fears about the government overstepping its financial bounds. So we'll
right.
get into that.
Yeah. Well, I'm fascinated. I'm going to listen in because uh, isn't cryptocurrency digital currency? Because there's nothing physical. I
Yeah,
mean, it's like you get a bunch of coins or
right,
bills. Is I don't know. I'm waiting for you to
right.
go on with your show.
The cryptocurrency is really decentralized, and that's one of the benefits of the cryptocurrency. As opposed to the central CBDC digital currency, which is centralized in the Federal Reserve. In any case, I'll get into that.
Okay. Oh well. I can't wait. Can't wait. I'll ask you some more questions at the end of your broadcast. Have a good time.
Okay, thank you. Okay, and thank you, Mr. Brown, and welcome, listening audience. Everett James, again, your trusty tax reporter, every Wednesday at 10 a.m., 1 p.m. On the East Coast and 10 a.m. on the West Coast. Well, folks, here we are in September, the last quarter, or actually the last third of the year of 2024. It won't be long before the days of tax filing, which Mr. Brown has mentioned, are going to be upon us. I'm here to at least help you become aware of some of your, not only your legal responsibilities, but some possible ways to reduce the liability to the federal government in the income tax. So, first, it's very, very important to keep you up to date on the CBDC, that stands for Central Bank Digital Currency. That's actually been on the drawing board of the Federal Reserve for well over a year now. And we have to go back to early March of last year when President Biden at the time issued an executive order in support of instituting the CBDC in this country. Well, the while technology is there, and while there are numerous business benefits of installing this particular, um, I guess, monetary system, um, the there are drawbacks that are very significant, and those drawbacks have to do with your personal liberty. The CBDC would be might be used to monitor the financial transactions of American citizens needlessly, and wind up being just a carbon copy of the digital currency system currently now in use in China and a number of other large countries. When it was considered by our elected representatives in the House of Representatives and the Senate, there was considerable concern, and not just concern, but worry that installing that digital currency system would just be a carbon copy of what's currently taking place in communist China today. In response to that danger to the financial privacy of the individual citizens, a number of representatives in the House of Representatives had been speaking out. One being the Majority Whip Tom Emmer, Emmer, which who was the Majority Whip, and it was through his leadership that the dangers of installing this type of system were brought to fold. A quote from him is that this bill is straightforward. It halts unelected bureaucrats from issuing a central bank digital currency or CBDC that would be detrimental to Americans' rights to financial privacy. We've already seen examples of governments weaponizing their financial system against their own citizens. Where have we seen it? Well, it's been, how would you believe, Canada, where Justin Trudeau's government froze the accounts of the truckers who were on strike a couple of years ago. And he froze their accounts because of the political stands that they took. Now, this has not been this has not been without exception, but it has spread. The system itself has spread throughout the world. But another example of overreach by the federal government is in Brazil, where you have a Supreme Court justice who has frozen the account of Elon Musk, and I can understand why Elon Musk, who has been the author of X, but I can understand why he's instructed all of his employees to leave the country. So this a lot of examples throughout the world. China being the prime example of a government overstepping its bounds and essentially controlling the population, or at least attempting to control the population through the use of the central bank digital currency system. So the House of Representatives has passed a bill number 5403. It's called the CBDC Anti-Surveillance State Act. That's quite a title, and hopefully you will get the drift. Anti-Surveillance State Act. And this was passed, but it does, according to the authors, stop unelected bureaucrats from issuing the CBDC, which would inevitably threaten Americans' right to financial privacy. At this stand, the at this point, um, the CBDC is pretty much stalled, has been stalled for several years, even though the government, our government, does not agree with the objectives of this anti-surveillance bill. But the rule, which is pretty hard and fast, is the bill that has been passed, and that bill would forbid the installation of a digital currency without this express approval legislatively by the Congress. So they have to have their congressional approval first before installing such a system. The one might ask is, what proof is there of um, possible surveillance and dictatorial steps by the federal government? Well, it's shown up certainly in Canada, and it's just recently again shown up in Brazil. And as I mentioned, the Supreme Court in Brazil has fined the Elon Musk company X for so-called violations of Brazilian law, and they've frozen the Starlink um, link Starlink company in the country, um, supposedly to be used to pay fines. So one has to be very aware of this possibility taking place right here, in this country. Okay, folks, the election season, as we know, is we're really in the throes of the election season. And as your trusty tax reporter, I would like to bring your attention to an article in the San Bernardino Sun, dated August 11th, just last month, and it has to do with the onslaught of tax increases, all contained in, you've heard it before, Proposition 5. It's going to be your November ballot is going to be in California, um, which is the subject of this my comments here. That November ballot is going to be an orgy of tax increases. But I would just remind all the California residents that basically 200, close to 250 years ago, there was a um, constitutional requirement that no county, and this is in California itself, no county, city, town, township, board of education, or school district shall incur any indebtedness or liability in any manner or for any purpose without without the consent of two-thirds of qualified electors. Okay, well, the uh, the current legislature in Sacramento has greased up the ballot, and they're trying to allow new debt to be passed instead of with two-thirds. They wanted to try to get it passed with only 55% approval instead of the two-thirds. And that is because quite a few polls have indicated that getting the approval for these additional funding measures would really have an uphill battle in getting the constitutionally required two-thirds mandate. So what did they do? They dropped the uh, approval requirement down to 55%. That's what their intent is. Technically, Prop 5 does not apply to all debt for everything, only debt supposedly for infrastructure, which is pretty much everything. And it's for publicly funded housing projects and all types of programs. The In the California Bay Area, San Francisco Bay Area, it's showing up in Regional Measure 4. And what that measure 4 would do is to raise property taxes in the 9 counties in that Bay Area. And they just take the money and spread it around like butter. As I mentioned, the polls have shown that it would be a tough climb to get the currently required two-thirds approval from voters. But if the Prop 5 is approved in November, Regional Measure 4 will be declared passed if it receives just 55% of the vote. So, what is this reporter's suggestion? If you're a registered voter in California, your ballot's going to arrive in the mail in the first week of October. Don't be shy. Tear that envelope open right away. You know, you may even hear moans of pleasure emanating from the infrastructure and quote affordable housing unquote bonds that are inserted in the ballot. Okay, so the you could take your annual tax increase, take the 30 years and multiply it by the annual tax increase just to see how much you're going to be paying it. Now, there's another category of bonds, the school bonds. Now, that unfortunately, well, depending on what side of the political aisle you belong to or follow, the school bonds, they already were able to get a approval level dropped to 55% approval instead of two-thirds. And that's because of the a change in the state constitution that was made 24 years ago by voters, basically, who were persuaded that the school, needed to, the school needed to have money for removing asbestos from the school buildings. So the that's pretty much the story. That the some people are calling calling this increase in tax measures or the attack on the two-thirds requirement an orgy, and it will be showing up in your ballot. So we would suggest, or this reporter at least would suggest, get quickly filling out the ballot, sending it in before even thinking any more about it. So at least your ballot will be registered, and vote no on Prop 5. So it's quite a deal. So the next thing that I think is probably very high on most of our concerns is Social Security. Wow, the projections are now that the trust fund is going to go dry. Is going to be bankrupt by 1933, and that's only about 8 years from now. Um, Now this is, you might say, a opposing view from the Republican ticket because of the fact that Mr. Trump has been saying that we don't need to touch any of the financing or funding of Social Security. I'm sure that's for political purposes. But the result of not touching it or making any changes, not making any changes in the Social Security funding law, just tends to make it even more insolvent. And so, of course, he's has been proposing that nothing is done at all. And this reporter would take an opposing view. Um, the Social Security is in a huge financial mess. The current benefit taxes bring in about 87 million in revenue each year, in addition to the payroll tax revenue. But even still, Social Security is still insolvent. Currently, it's projected, as I mentioned, that the main trust fund will dry up by 2033, about approximately 8 years from now. And exempting Social Security benefits from taxation would even move that date even closer, a year or so, even closer, 2032. So why should you care? Well, the current law requires that when insolvency happens, guess what happens? It requires a 23% across the board cut in benefits. And it will happen unless Congress reforms the program. But you have to remember that the insolvency that might happen is the reason why those taxes were adopted in the first place. The decision to tax the benefits really didn't happen until 1983, and as I recall, that was under Reagan, uh, and that's when the program was already in financial trouble. Additional taxes and an increase in the payroll tax, they were viewed as necessary means to keep the program solvent. Now, Congress should have reformed that program more fundamentally way back then. The way the program was initially designed, it just baked in eventual insolvency. The Congress really did take a politically convenient route, less responsible. And now we're paying the price for this political cowardice. The Now, lifting taxes on Social Security or not imposing taxes on Social Security, when you look at it from different points of view, it would also be very unfair. Contrary to common belief, seniors are really overrepresented in the top income quintile. As Brian Rito wrote one time, seniors have the lowest poverty rate of any age group, and their average household incomes have grown 4 times as fast as the average worker since 1980. Now, comparatively, younger people currently paying for seniors' benefits are more likely to be in the bottom of the income distribution. Again, the younger people are really carrying the load now. And Currently, Social Security redistributes benefits from the younger people to the higher income Americans. Lifting taxes would make this inequity even worse. Now, besides, seniors are already getting more in Social Security benefits than they paid in. According to an Urban Institute calculation, a married couple with two average earners retiring in 2025 will receive $831,000 in benefits over their lifetime, but will have paid in only 783,000 into the program. So the bottom line is that some seniors could absolutely absorb a reform in benefits. Lifting taxes on these relatively well-to-do seniors instead is a slap in the face for younger and poorer current workers. So the some advisors look at the pandemic era spending and found that the politicians are rewarded at the ballot box for doling out deficit finance benefits and making future generations pay the price. That future generations that they're referring to, of course, is our grandchildren. We're making we're making them, pay the price. Okay, um, so the while we're discussing the California politics, um, for one additional note for California residents, businesses fleeing California high costs should consider the Inland Empire. And I guess I might be, blowing the horn for the Inland Empire, which admittedly is the home, the residence of this particular reporter. But uh, Elon Musk's recent decision to move the headquarters of both X and SpaceX from California to Texas is the latest in the exodus of major businesses from California to other states. In the past decade, you've had Toyota, Tesla, Charles Schwab, Oracle, Hewlett Packard, McKesson, CBRE, Parsons Neutrogena, and Blaze Pizza have left the state, and a lot of other smaller and family-owned companies have left as well. Well, why are they leaving the Golden State? Well, there are a number of reasons. The businesses cite the specific reason. It's just too expensive to do business here. They note that the taxes, fees, rents, energies, utility costs, labor costs, among other things, are higher in California than in competing states. When Charles Schwab moved his company headquarters from California to Texas 5 years ago, he said the cost of doing business in Texas are in California are so much higher. So another point, number two, studies show that the some parts of California are more costly than others. So if you're planning to move here, that might give you, a heads up in what part of California to locate. The Most of the cities in the Inland Empire are either in a four-county region in Southern California, which is Los Angeles, Orange County, Riverside, and San Bernardino counties. I believe, and if I'm not wrong, San Bernardino is the largest county actually in the United States. uh, and there, in addition to direct business costs, the survey includes other indirect cost factors that help determine a city's relative attractiveness as a place to do business. And that includes also crime rates, which have been skyrocketing, and housing affordability, which you will recognize as having has has just continued to explode. Overall, cities in the Los Angeles County ranked as the survey's most expensive in the Western United States, with Santa Monica topping the list, followed by Culver City, Pasadena, and Malibu. By contrast, however, most of the survey's lowest cost cities are outside of California, being in Boise, Idaho, ranking as the least costly. Four counties in Nevada, plus Dallas and Houston, were among the survey's lowest cost locations. One stark difference between the cities in California and those in other states is the minimum wage. In California, the state minimum wage is now $16 per hour, with some cities, particularly in the LA area, mandating a minimum wages above that level. Now, in addition, as of April of this year, the fast food industry, wow, they're required to pay workers a minimum of $20 per hour. Proposition 32 on the November ballot now is proposing to raise the statewide minimum wage for other workers to $18 per hour. Now, by contrast, the minimum wage is $7.25 in Texas, Utah, and Idaho. 7.25 compared to 20. So there's quite a bit of cost differences just in the state of California. The cities as I mentioned, the most expensive, of course, in L.A. County, and the San Francisco Bay Area county. The the cost of doing business comparatively in the Inland Empire is considerably lower. The the city of Fontana in San Bernardino County stood out as the fifth lowest cost city in the entire survey. And that was the only California city to rank in the survey's 10 least costly cities. Now, while a lot of cities in Los Angeles County charge a sales tax, for example, of 10.25%, the sales tax in many inland counties is 7.75, 7.75%. So, of course, many businesses choose to remain in the high cost areas, primarily, due to the proximity to critical infrastructure, suppliers, and pool of talented and educated workers. So, for that's for the California situation, and we'll move on now to with the balance of our hour devoted to updates that you should be aware of. I think one of the major um, updates that we need to be aware of for those who are in the subchapter S category, and if they if yeah, the owners um, filed an extension request, you have until September 16th. Wow, here we are, in September 4, and really, that's only 12 days off, if my addition is right. Um, so, September 16th is the deadline. Now, if you file your return late, wow, there are some really, very, very heavy duty fines, $235 per person. Um, if you have more than one member um, in the subchapter S corporation, that's double that, $470 um, uh, per month that you file late. That can really add up in one heck of a hurry. So, I had I mentioned earlier that one of the major uh, groups of people who are really um, worried about what's going to happen with their benefits, as well as whether or not their benefits are even going to be available on a 100% basis. You still have We're still having to deal with being taxed on their benefits. Now, what are some of the rules about the taxability of Social Security? This reporter has frequently um, been asked that question, and there is a nice worksheet in the tax return that is automatically calculated by a by the software that the return is being prepared on. and but the worksheet itself is uh, almost incomprehensible unless you have someone sitting by you who's familiar with tax law. But that being what it is, some here are some of the general rules. Some people are not taxed on any of their Social Security benefits. They include individuals for whom Social Security is the sole or the primary source of their income. Many others, unfortunately, could owe tax, and you have to, attribute this to our great President Ronald Reagan. The uh, uh, the tax rate can be assessed at up to 85% of the Social Security benefits, and that depends on the amount of their other what they call quote provisional income. What is provisional income? Uh, the provisional income is generally equal to the combined total of one, tax exempt interest, and 50% of your Social Security benefits, and then other non Social Security income items that make up the adjusted gross income, minus, of course, certain deductions and exclusions. Okay, with that mouthful, it would be a lot simpler if you simply called a tax preparer or a tax professional and find out very, very easily. Basically, if you just look at the tax return itself, it will show the gross Social Security benefit, annual benefit, and then it will show over to the right on the page one of the 1040 what the tax is going to be. And if you consult a tax practitioner, that information will be relayed to you. By the way, this tax practitioner, if I have not already identified myself, Everett James, my phone number for calls is 951-522-9877. To repeat, 951-522-9877. And for those who are more disposed to using the internet, EVJTAX1 at gmail.com, EVJTAX1 at gmail.com. That one is just the numeral, don't spell it out. And we'll attempt to repeat that identifying information at the end of the hour. But keep in mind that we welcome your comments, your questions, particularly, and the promise that all questions submitted will be answered in the following week's program. For those who take advantage of this offer, there will be uh, a complimentary review of your coming tax year return with some possibilities of a complimentary completion of the 2024 tax return. So keep those things in mind. So going back to the Social Security uh, taxes that one has to face, after you go through this determination of what is your provisional amount of income, because the tax rates run from 50% to 85%. Hopefully, if you're receiving Social Security, you're only being taxed on 50% as opposed to 85%. The if you're a single filer, and if your provisional income is less than $25,000, then the benefits are tax free. Your home scot free. If the provisional income is between 25,000 and 34,000, then up to 50% of the benefits is taxable. If the provisional income is over 34,000, up to 85% is taxed. One more, if the joint filers, if your provisional income is less than 32,000, then the benefits are tax free. If the provisional income is between 32,000 and 44,000, then up to half of the benefits is taxable. If, however, your provisional income is over 44,000, up to 85% is tax. So, if you want federal income tax withheld, and I would certainly recommend that, too many taxpayers are neglecting this valuable way to start paying taxes on the year's income. But this is a very, very good way to do it. And there is a box on the Social Security form for you to use this opportunity to start making certain that enough money is withheld from Social Security to help pay that tax. The keep in mind that the tax breaks and income levels are indexed to inflation each year. Democrats have proposed bills over the years to raise the thresholds, but what happens, folks, is that those attempts to raise the thresholds they never pass, and that's because Social Security, along with other tax benefits and government support, are simply once they get passed, they're very, very difficult to amend or change. The So Donald Trump wants to end federal taxes of Social Security benefits. Oh, on July 31st, he posted on Truth Social, on his social media platform, seniors should not pay tax on Social Security. Well, he didn't really elaborate on how he would do this, and this reporter uh, I can probably prognosticate and predict that he may change his position on not taxing Social Security at all. Particularly, this would be from pressure from the more conservative wing of the Republican Party. Now, keep in mind, there's a lot of states for your state taxes that exempt Social Security benefits from state income tax, but not all. The outliers that tax all or part of the benefits are Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. Most of these have exemptions also based on income guidelines. Okay, well, folks, we are in the period of time that we are about ready to go back to school for professional teachers. Teachers should know about this tax break. It's called the educator expense deduction. Now, teachers can deduct up to $300 in 2024, and that would be our current tax year. And that's for the cost of their unreimbursed expenses. Now, this is an above the line, as they call it, deduction taken on Schedule 1 of the 1040. You don't have to itemize on Schedule A to claim it. Thank goodness. The cap is $600 for spouses who are both teachers and file a federal tax return. So it's actually $300 per person, and then for spouses it'd be $600. Homeschooling parents, unfortunately, do not get the break. It's only available to teachers K1 through K12, kindergarten through high school. It's only available to those educators who work 900 plus hours during the school year in an elementary or secondary school. So, folks, I guess that should be, if you're teaching school, that should be an incentive to make sure that you work 900 hours or more during the tax year so you can at least get that break. What are some of the expenses? Professional development fees, books, supplies, materials for the classroom, computer software, of course, plus COVID-19 protective items. And that has to cover a lot of territory. The the lawmakers have been itching to expand this break for years. For example, Republicans have introduced bills that would extend this to homeschooling parents, but so far, no luck. The homeschooling parents who are teaching don't qualify for this break. There is a recent House proposal that would raise the maximum deductions to $1,000. Wouldn't that be nice? Now, have you filed a tax return for someone who's passed away? Well, here's some of the tips. If you're a surviving spouse and you're filing joint, mark, of course, married filing jointly. If filing a paper return, write the word deceased along with the decedent's name and the date of death at the top of the 1040. Now, if you're using tax preparation software, software will do it for you when you mark that that person is has passed away. If there is a court appointed personal representative, that person must sign the 1040 along with the surviving spouse. If not, the surviving spouse would sign and write filing as surviving spouse in the decedent's signature block. If you're unmarried, mark the decedent's filing status as single or head of household. Write the decedent's name on the name line and the name and address of the personal representative. If filing a paper return, just put in deceased and the decedent's name and date of death. Of course, if you do this online or through a tax preparation service, a lot of these requirements are going to be, pretty much fairly easily um, fulfilled. The IRS does have an online tool to help you file a deceased person's tax return, and if it's a interactive tax assistant, it's called "How Do I File a Deceased Person's Tax Return?" And don't forget the qualifying widow or widower's filing status. This lets the surviving spouses with dependent children use the income tax brackets and the standard deductions for joint filers for 2 years after the decedent's death. Now, let's say, for example, say a husband dies in 2024, in this year, and then the wife is left with two minor children. The wife can file a joint return next spring. Then, for the next 2 years, for 2025 and 2026 tax return, the wife can file as a qualifying widower, provided she's still unmarried at the end of 2025 and 2026 and claims dependent children for those years. Okay, folks, as we move on to some of the tax tips that you don't want to run afoul on, how many of you have a hobby and you're trying to write off your regular income by claiming hobby expenses? Reporting hobby losses because of the prevalence of this practice is has been and is now and has been an audit red flag. IRS is on the hunt for filers who year after year report large losses from hobby sounding activities on their Schedule C. And they do that, of course, why? Well, to help offset their wages, offset their business income or earnings, or offset any other income, such as investment income. Revenue collected from a hobby, number one, is taxable. To repeat, revenue that you collect from a hobby is taxable, but you cannot deduct expenses. The 2017 Job Job Acts and Tax Cuts Act um, temporarily repealed through 2025 miscellaneous itemized deductions subject to the 2% of the adjusted gross income threshold, including hobby losses. So, um, I must say, as my experience as a tax reporter and preparer, the miscellaneous itemized deductions are some of the most difficult things for taxpayers to recognize as no longer being tax deductible. They were, as I say, repealed in 2017. Now, if you are in a legitimate business, in order to to deduct a loss, a Schedule C loss, you must first show that the business is actually a legitimate business, not just a hobby. It needs to be conducted with continuity, regularity, in a business-like manner. You must have a reasonable good faith objective of making a profit from it. Now, there are regulations provided by IRS that they call them safe harbor regulations. If your activity generates profit in 3 of 5 consecutive years, or 2 out of 7 years for horse breeding, but most people, the rule is 3 out of 5 consecutive years. The law presumes that you're in business to make a profit unless IRS establishes otherwise. Let me repeat that very fast and fixed regulation. If you if you are in that category, uh, and you do want to, or are attempting to um, deduct hobby losses, you the general rule is that you have to, in order to deduct those losses and expenses, you have to have had a profit in 3 of 5 taxable years. So, I mean, that's a pretty fast and regular rule. In 3 out of 5 consecutive years, you have to generate a profit. Now, if the hobby business analysis that can be very tricky. And it's very tricky if you cannot meet that safe harbor. That's because the determination of whether an activity is properly categorized as a category of business and then is based on each taxpayer's facts and circumstances. And then the courts and IRS look at 9 factors. What are those factors? Expertise of the taxpayer and the advisor, manner in which one carries on the activity, time and effort devoted to the venture, expectations or your expectation that assets used in the activity may appreciate, history of income and losses, amount of occasional profits, success in carrying on other activities, elements of personal pleasure or recreation that one gets from the activity, and whether the taxpayer has substantial income from other sources such as wages and investment incomes. So I'm not going to repeat all 3 of those again. We'd be happy to go into that in more depth at one of our coming Wednesday morning sessions. No one of those factors is determinative just by itself, but some are routinely given more weight. For example, managing your activity in a business-like manner can be very helpful in showing an honest intent to make a profit from a venture, and even though the activity has so far been generating only losses. And this factor is under your and this factor is under your control. Now, other helpful factors to establish a profit motive that are within your control: ensure you have the knowledge, training, or expertise to conduct the activity, or rely on the advice of industry experts. Also, devote lots of time and effort to the endeavor. So, just to let you know, the hobby loss rules, for one reason, I'm focusing on this a very important area is because IRS has been quite aware that taxpayers over time have been using their hobbies to write off the expenses, the taxes that are generated by having a job wage, um, and write off the taxes that are generated by profits in the investment field. This has been the way that many people have tried to do this, and oftentimes their activities fall into the category of what they call the gig economy. That is something that is that you do on the side while still maintaining a 40-hour a week job. The In these cases, the hobby lodge rules are frequently litigated in tax court. IRS generally always wins. That's partly because it tends to settle cases in which it does not believe it can prevail. So those that they just set aside and give the break to the taxpayer. Uh, but if you go to court, it's typically you're going to be looking at a loss if you're going up against IRS. Now, here's an example in which the court canceled a writer's Schedule C losses after finding that the lady's activity was a hobby and a not for profit activity. Among the factors that weighed against her, she never had a business plan. She didn't keep good records. She couldn't substantiate most of her expenses. She had 30 years of large losses before eking out a profit in 2022. She couldn't show that she put substantial time into the activity. She didn't seek the advice of experts running her business. And both she and her husband had other income sources, mainly consisting of wages. So the court, in addition to disallowing the Schedule C losses, they upheld IRS's determination of the 20% accuracy related penalty for negligence. So there's a negligence, uh, you know, a negligence penalty that you're likely to get if you persist in using um, activities to write off your wages or your investment income, and in those in that activity that you're writing off, there's actually you don't realize any profit. And if it's done over and over again, IRS is going to very, very quickly determine that this is a hobby, and therefore you can't write off any deductions. You cannot write off any losses. Okay, IRS is slowly tracking its backlog of the employee retention credit claims, and you've heard about those claims as being the source of a great deal of fraudulent claims. In September 2023, last year, the agency halted its processing of the employee retention refund claims entirely. It has recently sent out, you know, 28,000 letters denying refunds to employers that, according to IRS, they submitted ERC claims, employee retention claims, that showed a high risk of error. Now, it will soon process 50,000 claims, which per IRS have zero risk or low risk of errors and were filed before September 14th, 23. So IRS is mapped out and scoped out these claims, and for those that showed a low risk of error, they've generally gone ahead and paid off those claims. But for those who have showed been in the area where there's a high risk error, they put those aside. And many times they are absolutely just rejecting those out of hand. So there are some employers who are getting really antsy, waiting for IRS to pay them their ERC money. A few decided to even go to court. they're suing the service to recover amounts they say are due to them. For example, a firm filed a complaint in a federal district court in Pennsylvania claiming that it qualifies for the ERC. It filed a 941X claim way back in January of this year, and IRS has not yet paid out the refund. This taxpayer may be in deep water financially on this one. The taxes is going to be the center stage next year. Lots of provisions in the 2017 tax law are set to end after next year. So enjoy the benefits that were allowed by former President Donald Trump back in 2017 when the Tax Cuts and Job Act was passed, and there were tons of breaks that have been enjoyed since 2017 tax reporting year. And unless Congress gets this act together and passes new laws that either uphold those laws, they're all going to expire at the end of 2025. So 2025 is going to be the last year you're going to get the benefit of that enhanced child tax credit of $2,000. It'll just go back to $1,000. Everything will revert if no action is taken legislatively. All the tax law would revert to what was current, back at the end of 2017. So it shouldn't come as any surprise.
Okay.
So with that, we will end our session for this week, and look forward to being with you next Wednesday at the same time, 10 a.m. Western and 1 p.m. Eastern time. And we'll turn it back over to the host, William Brown.
All right, Eric. Thank you so much. I didn't mean for that little warning to play so long. Sometimes, the fingers don't work the way they're supposed to. You know what I mean?
Yes.
But, yes. But anyway, I do want to ask you this. I was going to ask you another question. We'll say this for another time. But you talking about the child tax credit that Congress is refusing to pass.
Mm-hmm.
Yeah, and that is really disturbing. And also, you have some Congress people and even local legislators that don't want to feed the children. I mean, who would go against that? I mean, there are laws around the country.
Yep.
Some governors, and legislators, they're saying we need to give free lunch to our children because it's hard to learn without having food in your stomach. I understand that.
Yeah, that's actually that's really a moral, ethical question in many ways, because who would want to subject children to not having adequate nutrition? That's that's a human rights, almost a human rights issue above and beyond the political requirements.
Right. So you have to look.
I would tend to think that Congress, both houses, are going to be in favor of renewing the child tax credit, not only just renewing, the $2,000 tax break for their credit, but extending it and increasing it, particularly because of the country's recent absorption of so many new children who are not American citizens.
Yeah, I mean, look, no child should go hungry. I don't care if you're American or not. And it makes no sense to me. But I do know for a fact, and we're not going to get political on this, but the Republicans have been shooting it down. If you do your research, you find out the Republicans in Congress, and in a lot of cases, the Senate, they've been going against everything that they complain about. And especially, let's get back on these children, though.
Yeah.
We have children out here who that's sometimes the only meals that they get is at school.
Yeah. And that includes that includes resident citizens as
Yeah,
well as
of
those who
course.
are new to the country.
No, that's right. They don't care because that bill said no
Yeah,
matter what your status is, you gonna
yeah.
get free breakfast and free lunch.
Hmm.
And it just like you say, it's more of a moral situation there, but it
Uh,
takes Congress to straighten this whole thing out. But
yeah.
anyway, El, a great show, man.
Okay.
Always great information.
Thank you.
And I will talk to you a little bit later on today. All right.
Okay. Being that. Talk to
All
you
right,
later.
my friend. Thank you so much.
Uh-huh.
Guys, and if you like the F said, if you want to hear the show again, matter of fact, you can go on YouTube. We have a brand new YouTube channel. That's Studio W The Buzz, Studio W The Buzz, and you can watch it again right now, if in case you missed it. Also, you can go on the Studio W The Buzz Facebook. It's on our sports page. It's on Teens Talk Truth. It's on LinkedIn. And it will be up on the website a little bit later on. All right, guys. Hey, enjoy your Wednesday.